All right, very good morning, everyone, and welcome to a brand new week. Now, two birds, one stone today. I'll cover sentiment first, and then we'll quickly take a look at the week ahead. Had a slightly later start today, so we'll be covering both of them in this video. Now, let's start with overall sentiment. I think sentiment is feeling a little bit better today after Friday's roller coaster that we had following that US jobs data. I mean, initially, if you take a look at things like equities, equities was able, at least in the form of the S&P, to push to all-time record highs as the miss in jobs data saw the markets pricing the scope for 3 cuts for the Fed this year instead of the 2 cuts that was fully priced in. However, I mean, just like the last NFP that we had, the initial optimism, it faded fairly quickly on concerns about the labor market resurfacing, just like we saw with the prior print. This came on the back, let me just get this data up. This came on the back of a further downward revision in that June data, down -13. Now, that was the first contraction in jobs since COVID, since December 2020. So obviously that miss is what spooked equity markets a little bit on Friday. That has also become like the main story for markets over the course of the weekend. It sparked chatter about whether the Fed could even go for a possible chunky 50 basis point cut in September. Look, I think right now that's unlikely, because if you think about how many possible meetings we've got coming up in a very short space of time. I mean, just look towards the first quarter of next year. If they cut every single meeting that's left for this year, that's September and October and December, they can do another one in Jan, another one in March, another one in April. It just feels like going for 50 would be their way of acknowledging that, oh crap, yeah, we are actually too late. We are actually behind the curve. And why would they want to do that? Right? I just feel I feel like that from a optics point of view would just be really crappy. And the markets, I think, won't take a cut like that in a good way. I think there is a risk that could be seen as a bad cut, like, oh crap, they think it's serious enough to go 50. They should have gone earlier. So I think it's more likely that we just get 3 cuts this year instead of the 2 cuts that was fully priced in. And we're very close to pricing in those 3 cuts anyway. We've got a fully priced cut for September. We're about 5 basis points shy for October. We're about 3 and a bit basis points shy for December. So I feel 3 cuts make sense, and I feel that's a easier way to get the job done, basically. But anyway, rates markets are doing what they always do, and that is going from one extreme to the other. So there is that flirtation, if you will, going on right now about the potential of a 50 basis point cut, but I feel that is unlikely. I feel 3 cuts makes a lot more sense than going one big one and potentially doing another big one. It just feels a little bit too aggressive. So in terms of where we are, I mean, let's start with Friday's close. Friday things look pretty ugly, right? We had some initial upside followed by the big downside. Then we saw some marginal recovery going into the close, but it wasn't a very pretty close. So far, though, in today's Asia Pac session, sentiment has been a little bit steadier. The one that's that's outperforming everything else has been the Nikkei, of course. The Nikkei was up close to 2%, currently still up 2% on the session, but that is more to do with what's happening in Japan. For those of you who don't know, over the weekend, we had news that PM Ishiba has finally resigned. There was some speculation that he would, after that very, very bad outcome that they got in the previous election. So there was some speculation that would happen. That was now confirmed over the weekend. It saw some initial weakness in the yen, which obviously is normally supportive for the Nikkei. But the other driver for upside here in the Nikkei is the fact that because of this resignation, there is now speculation that we could see the BOJ staying a lot more patient than what the markets had previously anticipated, right? So that hike that was flirted with a couple of weeks ago might not be a reality now. They might have to push that out a little bit further. So that is obviously the fact that the idea of a lower currency with the potential for no more hikes, that has obviously sent the Nikkei higher. But apart from that, everything else is doing okay. Yes, we are seeing a little bit of downside for the FTSE, but so far everything else is trading in the green. So just a little bit more steady compared to where we ended the week on Friday. In terms of the FX space, before we touch on sentiment, let's take a look at what happened to the dollar. I mean, big move to the downside there for the US dollar on the back of that miss in NFP. Now, as we discussed last week, I was of the opinion that we really needed to see either massive downward revisions to the May and the June data, as well as a big contraction in NFP, or just a contraction in NFP, or alternatively a massive pop to the upside in the unemployment rate to really see shorts kicking into overdrive. The fact that the data came in weak, yes, that saw the initial downside for the dollar, but there was no, in my opinion, there was no reason to chase the dollar lower on Friday with that data. Not just because we are testing major support that has held quite a few times now, but the fact that the markets were already short the dollar going into this, and we knew that we needed to see something truly negative, truly really ugly, to get shorts even more interested in shorting on the back of that data. Furthermore, we're now going into CPI this week, which we'll touch on in a second, and there is some bounce risk, right, from this key level of support if we see really hot data coming out from the PPI and the CPI. So that, I think, does change the scope a little bit here for the US dollar. Look, from a medium-term point of view, the labor market is slowing. The markets are pricing in more cuts. So yes, theoretically, that should still be a negative for the dollar. And who knows, maybe we do break lower and trade lower, but that for me, just it's not a high conviction, high probability trade at this stage. I would rather wait for CPI and PPI. If those data points comes in super weak, then obviously we could see new lows being broken, at least recent lows, potentially revisiting that 97.10, maybe even that 96.40. Which is the low going back to July. But again, I'll want to wait for that data before I get excited about that. Apart from that, like we mentioned, the yen was the weakest currency on the session earlier, currently still the weaker currency by a very, very small margin. That came on the back of the resignation from the PM. We saw some pretty gnarly gaps in yen pairs. I mean, dollar yen gap to the upside, every yen pair gap to the upside, but a lot of those gaps have been starting to fall so far in the session. You can see dollar yen pushing lower, not as big of a recovery in other ones, but you can see CAD yen pushing lower, Swiss yen marginally lower as well. So we are seeing a little bit of a recovery in those earlier gaps, but still some room to run for some of them. Apart from that, despite the overall more positive tone so far today, the Swiss franc is also trading up alongside the Aussie and the Kiwi, mainly on the back of news from SNB's Schlegel over the weekend, who said that, another rate cut is unlikely anytime soon because they wanted to avoid negative interest rates. Now, I don't know about you guys, but that kind of feels a little bit disingenuous because previously they told us that, oh yeah, negative rates is definitely on the table. That was just a few weeks ago. Now it seems like they're off the table again. You know what? I don't like the SNB. I don't like the way that they play with markets. I don't like the Swiss franc as well. But anyway, that's just my personal bias. But that has seen a little bit more strength despite the more positive flows we've seen in the likes of the Aussie as well as the Kiwi. The CAD, the other one that had a pretty bad day on Friday, still pressured so far in the session. It's one of the weaker ones on the session on the back of that huge miss that we had in the jobs data. I mean, some of those moves. The dollar move was a little bit more contained, obviously on the back of the dollar itself. But take a look at some of these pairs. I mean, pound CAD, massive pop to the upside. Kiwi CAD up, Aussie CAD up. It was just a really bad day for the CAD. And based on that data, I would not be surprised to see some continuation of that weakness in the week ahead, because there's just very little reasons to like the Canadian dollar right now. Apart from that, looking over to commodities, we obviously had oil down on Friday on the back of fears of an even bigger production lift from OPEC, but it is a little bit firmer today, both WTI and Brent crude, after OPEC confirmed that the October hike will be just 137 thousand barrels per day. That is smaller than the previous signal. So the markets are seeing that as them just being a little bit cautious of the reaction that we saw in price. And that is basically just giving an excuse for WTI to bounce from that very key level of support around that $62 per barrel level. However, the more interesting mover really from last week has been gold. I mean, what a move this has been. New all-time highs once again today for gold in the aftermath of that jobs data. Look, gold didn't need yields to go lower or the dollar to go lower to push up recently, right? It's been able to push up even with a stronger dollar and higher yields. But the fact that both of those two things did push lower on Friday. It's obviously helped gold quite a lot, and it's just such a strong move. I spoke to a friend who is a risk manager. I won't say where. Spoke to them both last week as well as this week today. And he says that retail just keeps on piling in on gold shorts. They keep on shorting the living daylights out of this thing, obviously expecting a big pullback at some stage. Now, that could mean two things. It could mean that there's even more pain to come, because usually, retail gets punished when they are this aggressively short against a freight train like this. Or alternatively, maybe they get lucky this week, because if CPI and PPI does come out very, very hot, then there could be a little bit of a reprieve lower. But for now, just a monster of a move, not something that I would be wanting to get on the other side of, that's for sure. This has just been moving like an absolute freight train. Apart from that, bonds have been fairly uneventful so far. Obviously, the big moves all played out on Friday. Big pop to the upside for bond futures. If you take a look at the ZN contract, just a big move higher, getting close to those highs that we saw back in April. And obviously, the equivalent of that was a big move lower in US 10-year yields, back down towards that, very close to 4.085. A big move lower today, a little bit more calm, and obviously there will be a lot of focus for yields on inflation this week, as always. So with that said, let's quickly take a look then at the week ahead. Look, apart from US data, guys, it is very, very boring stuff this week. We've got very little to be excited about outside the US. That means that the main focus, all of the excitement, will be on US PPI as well as CPI. We do get the ECB coming out, but markets are largely expecting that to be a nothing burger, with very, very little movement as well as volatility, expected from that. So that means the main events will be firstly PPI coming up on Wednesday, and then CPI coming up on Thursday. Now for PPI, this is one of those months, we usually get them about 2 or 3 times a year. This is one of those months where PPI actually precedes CPI. Usually we get CPI first, then we get PPI, then we get PCE. But because we get PPI first this month, that means that there will be more attention on the PPI compared to usual, because markets will likely try to front run the CPI based on whether we get any major surprises in the PPI data. For example, if PPI comes in incredibly hotter than expected, the markets might front run that as a hotter CPI print. Vice versa, if it's just a massive miss, they could front run that on the CPI data as well. Doesn't mean that it's going to play out that way, right? Normally PPI can have some predictability in terms of where CPI might land, but it's not always the case, right? So you might have hot PPI and you can even get a lower CPI. It has happened before. It's possible. Just, take note that the markets might, regardless of that, might look to front run CPI a little bit based on what we get from PPI. Now, markets are obviously bracing for both. Not really because they'll change the fact that the Fed is cutting rates in September. That one is completely locked in. It was already locked in my opinion, regardless of the jobs data that we had. We spoke about that last week. But they will be focused on these prints because they'll tell us just how sticky inflation still is. And that'll obviously shape the story for the months ahead in terms of cutting rates, right? Let's quickly take a look at what is expected from both of these two prints. So for PPI, markets are expecting largely flat, apart from the core measures, which is expected to cool slightly from 3.7 to 3.5. But expected flat for the year-over-year headline. In terms of core CPI, that is expected flat on the month-over-month, flat on the year-over-year. Slight upside expectation for the month-over-month from 0.2 to 0.3, and a slight pop higher for the headline from 2.7 to 2.9. Now, this CPI and PPI for that matter, but this CPI is the last big data print before the Fed meeting that we have on coming up next week. And while the weak payrolls data that we had means that the Fed will definitely cut at that meeting, the inflation data this week could decide how aggressive markets are pricing in future cuts, right? We just said earlier that if you take a look at how markets responded on that jobs data, the markets we are 7 basis points shy, less than 7 basis points shy, let's just call it 6 basis points shy, of fully pricing in 3 cuts for this year. But if CPI was to come in super, super, super hot, that could obviously start seeing the scope of that October meeting being faded out a little bit again, right? So if we were to get really, really hot data, it won't change September. It probably won't change December's outlook for cuts, but it could change that October meeting a little bit. And that could obviously be worth a trade in the short term if we were to get hot data. Obviously, if we were to get very, very low surprises, that probably fully prices in those cuts, and that probably sees the markets fully pricing in a cut even for January, maybe even March as well. So there is a lot to play for in the short term, not because of September, I would say even December, but more so on how that could potentially impact expectations for October, and like I said, January as well as March. Now, in terms of possible opportunities, look, let's start with FX. I think when it comes to the dollar, we know the market's already short the US dollar. They were short the dollar heading into Jackson Hole, and that hasn't really changed. I think the lack of follow through lower in the dollar after Friday's data, I think that confirms the positioning stance right now. And I think for me, that means for the dollar, the base case scenario for a short-term trade this week is if we were to see really hot inflation data, both PPI and CPI, that could see the dollar pop higher. And because it could potentially see those short plays being squeezed a little bit. I won't look at that as anything more than a technical bounce though. But as long as we stay close to this level, there could be both a tactical as well as a sentiment reason to trade that higher if the data comes in really hot. If the data should surprise massively to the downside, there could obviously be scope to trade the dollar lower as well. Key levels to aim for there to the downside would be that 97.10, like we mentioned earlier. If it's a big enough miss in both of those two data points, I mean, we could potentially even break below that low. But that would be a key level to watch for. And then to the upside, we've got obvious levels of resistance between that 98.40 and that 98.60 level to watch out for the week ahead as well. In terms of equities, look, I think the sweet spot for equities this week would be a softer CPI print, right? If we were to see inflation surprise to the downside for both PPI as well as CPI, what does that give us? That gives us less fears about inflation surprising higher. We have growth currently still tracking well north of 3%. You've got a bunch of rate cuts priced in, which potentially could be even more if inflation comes in lower. What's not to like about equities in that environment, right? Yes, the labor market will obviously still be a concern, but with growth being good, with cuts being priced in, if inflation should surprise lower, that just feels like the obvious play for equities for possible upside. So if we were to see some decent misses, I wouldn't be surprised to see the likes of the S&P trading into new all-time highs, potentially seeing the Nasdaq break out to new all-time highs as well. Look, what if the data comes in really, really hot? Then obviously we could see a little bit of downside playing out, but with growth again still solid, with cuts still being priced in, I don't think that changes the medium-term picture, and we likely see any dips on a slightly hotter number being bought back when it comes to equities. But the cleanest play for a short-term move, in my opinion, would be a miss, seeing upside there. In terms of gold, look, for this one, it's obviously been a fantastic mover regardless of what the data has been recently. And we are sitting close to all-time highs, which, look, technically it does look a little bit stretched by the looks of it. But if CPI could see a massive miss to the downside, geez, we could see a mammoth of a move in gold to the upside. I just mentioned earlier that we know that the retail crowd has been piling into shorts. So there's a lot of reason for this thing to go even higher. So I would not mind possible upside plays in gold in the short term if CPI surprises to the downside. On the contrary, look, if we were to see a massive upside surprise in CPI, that could give short-term traders some potential to trade gold lower. But you know, you would have to be very careful on that, because even if it is a hot number, it's not going to change the scope for the Fed cutting rates. They will be cutting rates. It'll just be a case of them cutting a little bit less than what we thought on Friday. So you want to be very careful on trading gold lower on the back of a hot print, because you never know when the medium term buyers will step back in and buy back. So just be careful of that. But that could certainly be a trade to the downside. It could see a little bit of these weaker hands at the highs being flushed out if it is a super hot print. So that's going to be the main highlights. It'll be PPI, it'll be CPI. And again, I think those are the ways that I'll be looking to approach FX equities as well as commodities on the back of that CPI. So with that said, hope everybody will have a fantastic week ahead. As always, any questions, don't hesitate to let me know.